Did you know that nearly 80% of the world's wealth is controlled by just 1% of the population? But here's the kicker. Many of those who are part of the 1% didn't get there by working harder. They got there by making their money work for them. Imagine if you could create income while you sleep, or better yet, quit your job without stressing about your next paycheck. In this video, we're going to show you how to do just that. We'll reveal 6 powerful passive income investments that can give you the freedom to live life on your terms. These aren't your typical tips. You'll learn about hidden opportunities that value investors are using right now to build wealth. From real estate to digital businesses, there are ways to start earning without being glued to a desk. If you're ready to break free from the 9-to-5 grind, keep watching. It's time to turn your money into your most powerful employee. Chapter 1. The Sleeping Giant. Dividend stocks that pay while you dream. Investing in dividend stocks is one of the oldest and most reliable strategies for creating passive income. It's like finding a money tree in your backyard that just keeps growing. But here's the catch. Many investors overlook dividend stocks that could pay you consistently while you sleep. These sleeping giants have the potential to not only deliver dividends but also grow in value over time. Take Procter & Gamble, for example. This company has raised its dividend for 65 consecutive years. That's over 6 decades of steady growth. It's the kind of stock that's boring to talk about but highly effective for value investors. Many dividend stocks like this don't get the spotlight, but they offer something that the stock market can't provide: stability. The strategy behind these stocks is simple: buy and hold for the long term. Instead of trying to time the market, focus on companies with strong fundamentals, reliable cash flow, and a track record of paying dividends. It's about playing the long game. For instance, Coca-Cola is another example. While the stock might not have the explosive growth of tech companies, its dividends have grown year after year. It's a case of slow and steady wins the race. What makes dividend stocks particularly attractive to value investors is their predictable cash flow. According to a study by Ned Davis Research, dividends accounted for about 40% of total stock market returns since 1926. That's a significant chunk. This means that over time, dividends can help you steadily build wealth. But it's not just about finding any dividend stock. The key is identifying those that are undervalued and poised for growth. Companies that consistently pay dividends are often seen as more stable and less risky. A great example is Johnson & Johnson, which is not only a dividend payer but also has a wide economic moat, a competitive advantage that protects it from competitors. When looking for dividend stocks, consider the dividend aristocrats, a group of companies that have increased their dividends for 25 consecutive years. These stocks are often less volatile and come with a history of solid performance. While these companies might not make headlines every day, their steady income and growth make them ideal for passive investors. In the end, dividend investing isn't about getting rich quick. It's about creating a steady stream of income that can eventually replace your job. And if you're willing to wait, dividend stocks can help you achieve just that. Chapter 2. Hidden Gems. Real estate investment trusts, REITs, with massive upside. Real estate investment trusts, REITs, are another underrated gem in the world of passive income. While many people think of real estate as requiring huge amounts of capital, REITs allow you to invest in real estate without owning a single property. And some of the best REITs are practically hiding in plain sight. REITs function like a stock exchange traded fund but with real estate. They pool investors' money to buy, manage, and sell properties. The result? Passive income generated from rental yields or property appreciation, distributed as dividends. While they are often overlooked in favor of stocks, REITs can provide a steady cash flow with the potential for long-term capital gains. Here's the twist. Not all REITs are created equal. The best ones are those that focus on niche sectors within the real estate market, like data centers, industrial properties, or healthcare facilities. These markets often offer higher returns and less competition. For instance, Digital Realty Trust, a REIT focused on data centers, saw its stock price grow over 300% in the past decade. With the rise of cloud computing, data centers are in high demand, and REITs like this are capitalizing on it. But what makes REITs so attractive to value investors is their ability to pay out most of their income. By law, REITs must distribute at least 90% of their taxable income as dividends. This creates a high dividend yield, making them perfect for passive income seekers. The National Association of Real Estate Investment Trusts, NAREIT, reports that the average dividend yield for a REIT is around 4%, significantly higher than many traditional stocks. When selecting REITs, focus on those that are undervalued due to temporary market conditions. For instance, some retail-focused REITs saw their stock prices plummet during the pandemic, but their long-term prospects remain strong as e-commerce companies need more warehouse space. These are the types of REITs that value investors should target for long-term passive income. Just like dividend stocks, REITs work best when you focus on the long term. The key is to understand the market trends, spot the undervalued opportunities, and hold on for the ride. With real estate prices historically rising over time, REITs present a unique opportunity to capture that growth without the hassle of property management. Chapter 3. The Secret World of Peer-to-Peer Lending. Where risk meets reward, peer-to-peer, P2P. Lending is a relatively new but growing sector that allows investors to lend money directly to borrowers, cutting out traditional financial institutions. It's an alternative way of generating passive income that many value investors overlook. What makes P2P lending particularly intriguing is the high returns it can offer, especially if you're willing to take on a bit of risk. Think of P2P lending as a way to act as your own bank. You lend money to individuals or small businesses, and in return, you earn interest. While some investors might shy away from this due to perceived risk, P2P lending platforms like Lending Club and Prosper have seen strong growth. According to Lending Club, investors have earned over $1 billion in interest since the platform's inception. That's not too shabby for an alternative investment. The key strategy in P2P lending is diversification. By spreading your investment across a range of borrowers, you reduce your exposure to any single risk. You might be lending to borrowers with varying credit scores, and while some might default, others will repay with interest. The more loans you have in your portfolio, the better your chances of earning a steady return. Risk is a real factor in P2P lending, but it can be managed through smart investing. According to a study by the Cambridge Center for Alternative Finance, the average return on P2P loans is around 4.7% per year. While that might not seem huge compared to the stock market, it's still a reliable way to earn passive income, especially when you're investing in a more stable economy. What's really attractive about P2P lending is that it allows you to invest in a way that aligns with your values. For instance, platforms like Funding Circle allow you to invest in small businesses, helping them grow while generating returns. And since most P2P lending platforms have low minimum investment requirements, it's easy to start small and scale up over time. But remember, the key to success in P2P lending is doing your homework. Many platforms offer grading systems that rate borrowers based on their creditworthiness. By choosing higher-rated loans, you reduce the risk of defaults and increase the chances of receiving consistent passive income. The biggest takeaway here is that P2P lending can be a valuable addition to your passive income portfolio. When used wisely, it provides a way to tap into an alternative market while diversifying your investments. Subscribe now to stay updated on more innovative investment strategies like these. Chapter 4. Money on Autopilot. The Magic of Index Funds in Undervalued Markets. If you're looking for a simple, yet powerful strategy for passive income, index funds should be at the top of your list. Index funds track the performance of a market index, such as the S&P 500, allowing you to invest in a broad range of stocks with a single purchase. The beauty of index funds lies in their simplicity and the fact that they often outperform actively managed funds over time. Over the past 50 years, the average annual return of the S&P 500 has been around 10%. While this is a general market trend, when you focus on undervalued markets or specific sectors within those indices, you can potentially see even higher returns. For example, during the 2008 financial crisis, many markets were undervalued, and those who invested in index funds during that time saw massive gains when the market recovered. The key to success with index funds is to buy low and hold for the long term. Warren Buffett, one of the world's most successful investors, has famously said, "The stock market is a device for transferring money from the impatient to the patient." This couldn't be truer when it comes to index funds. If you're in it for the long haul, even during market downturns, your returns will likely be impressive. You don't need to pick individual stocks or time the market with index funds. Instead, you focus on finding undervalued sectors or global indices that offer significant growth potential. The global markets have been growing for decades, and while certain regions may face temporary challenges, their long-term growth outlook remains strong. A great example is the Emerging Markets Index, which has provided outsized returns over time, especially for investors who purchased during market dips. A particularly interesting strategy within index funds is focusing on thematic ETFs, funds that track niche industries or trends. For instance, the clean energy sector has seen tremendous growth in recent years. With governments worldwide pushing for greener solutions, investing in a clean energy index fund could offer substantial returns over time. Index funds are also incredibly cost-efficient. Unlike actively managed funds, which have higher fees, index funds typically have very low expense ratios. This means more of your money is working for you. In fact, research by Vanguard shows that the average expense ratio for index funds is just 0.1%, compared to 1% or more for actively managed funds. By focusing on undervalued markets or emerging trends, index funds allow you to make your money work for you without having to constantly monitor individual investments. It's truly a strategy where time is your ally, and the magic of compounding returns will pay off in the long run. Chapter 5. The Art of Building a Digital Empire. Investing in online businesses. When most people think about investing, they picture stocks, real estate, or bonds. But one of the most exciting and profitable ways to build passive income today is by investing in online businesses. In fact, buying and running online businesses has become a popular strategy for value investors looking for high returns with lower initial capital. The appeal of online businesses is clear. They often require much less capital to start than traditional businesses, and they can be run from anywhere. Think about websites, blogs, e-commerce stores, or digital products like courses or software. These digital assets can be highly profitable with the right strategy, and they require minimal ongoing effort once they are set up. One powerful method is to buy established online businesses through platforms like Flippa or Empire Flippers. These platforms allow you to purchase profitable websites or e-commerce stores that already generate revenue. According to a report by Empire Flippers, the average annual return on investment for online businesses purchased through their platform can be as high as 30%, which is much higher than traditional stock market investments. The best part? You can automate many aspects of an online business. From automated email marketing systems to dropshipping or affiliate marketing, there are countless tools that allow you to generate income passively. Once the business is set up, you can often just monitor performance and adjust the strategy as needed. Building an online business from scratch is also a viable option. If you're entrepreneurial and willing to put in the effort, creating a profitable website or digital product can become a steady source of income. A well-known example is Pat Flynn, who built his blog, Smart Passive Income, into a multi-million-dollar business. His model focuses on teaching others how to generate passive income through digital products, affiliate marketing, and online courses. The great thing about online businesses is that they often scale very well. For instance, once you've developed a high-converting sales funnel or a successful product, you can scale it without a huge increase in costs. This is one of the reasons why the returns can be so high, because your initial work is leveraged to bring in more income over time. Investing in online businesses isn't about the fast buck, it's about building a long-term, passive income stream that grows with time. With the right strategy, online businesses can provide a higher return than many other traditional forms of investment. Chapter 6. Collecting passive income like a pro. The power of crowdfunding. Crowdfunding has revolutionized the way people invest, making it easier than ever to put your money into promising projects with high returns. Instead of going through traditional investment routes, you can now invest directly in startups, real estate projects, or even small businesses. And for value investors, crowdfunding is an excellent way to gain exposure to high-growth potential investments without having to manage them yourself. Real estate crowdfunding platforms like Fundrise and Realty Mogul have allowed ordinary investors to get involved in real estate deals that were once only accessible to the wealthy. According to Fundrise, their average annual return has ranged between 8–12% over the past few years. This offers a solid passive income opportunity for anyone looking to get involved in real estate but without the hassle of buying and managing physical properties. But crowdfunding doesn't stop with real estate. Equity crowdfunding allows you to invest in early-stage startups, often in exchange for equity. These investments carry more risk, but they also offer the potential for explosive returns if the company succeeds. For example, platforms like Seed Invest and Crowdcube allow you to invest in startups in exchange for ownership, and some of these startups may grow to be the next big thing. One interesting aspect of crowdfunding is that it enables you to diversify your investments in a way that wasn't possible before. You can invest small amounts into a wide range of projects or companies. This way, even if one investment doesn't work out, you have several others that may be successful. However, just like any investment, it's important to do your due diligence. Crowdfunding platforms often provide detailed information about the projects or businesses they list, but it's crucial to read the fine print. Assess the risk and the projected returns, and make sure you're comfortable with the level of involvement and risk each investment entails. For those who prefer a hands-off approach, crowdfunding platforms also offer automatic investment options. These are similar to index funds, where your money is distributed across a range of investments, allowing you to build a diversified portfolio without constant management. Ultimately, crowdfunding offers an exciting new way to diversify your passive income streams and get involved in high-growth markets. Whether it's real estate, startups, or other ventures, crowdfunding allows value investors to put their money into projects that can provide solid returns over time. Don't forget to hit subscribe for more tips and strategies on building wealth with passive income.